JEPI's getting all the attention lately. Great returns versus its benchmark and a huge dividend paid monthly. JEPI's benchmark is the S&P 500, but over the last 10 years, the NASDAQ has beat the S&P 500. So shouldn't there be a sister fund that's like JEPI, but for the NASDAQ? A quick disclaimer, I'm not a financial advisor, I'm just sharing my personal experiences. Always do your own research before investing. I think the elevator pitch for JEPQ would be, it's the tech version of JEPI. Simple. The two funds, JEPI and JEPQ, share a lot of similarities, but I don't want to bore those of you that have already watched my JEPI video, so I'll focus in this episode on the differences between the funds. And if you haven't seen the JEPI video, I'll put a link in the description so that you can catch up. JEPQ yields 8.92% according to Seeking Alpha. And then if you look at Yahoo Finance, it yields 15.89%. That's odd. And then I disagree with both of those numbers, which is why I used 13% for the title of this video. So I'll quickly explain the confusion so that you can make up your own mind about which number to use. Dividend yields are calculated on 12 months of historical data. And as I record this in late January of 2023, JEPQ has made 8 payments so far because it's just under 9 months old. And if we look at the dividend history on Seeking Alpha, we get the data that we need to understand what's going on. I pasted the numbers from the Seeking Alpha table into a spreadsheet, and you can see that the total of those 8 monthly payouts is $3.85. If you divide the $3.85 by the current price of $43.33, it produces a yield of 8.9%. That explains the Seeking Alpha yield. Their formula divides total dividends from the past 12 months by the current price. And that formula works unless the fund is less than 12 months old. So unless JEPQ pays 0 dividends for the next 4 months, that formula is going to produce a yield that underestimates the actual yield. What about Yahoo Finance? Well, if you take the most recent payout of 58 cents and multiply it by 12, you get $6.91. Divide that by the price, and you get the Yahoo yield of 15.9%. That formula would work if the dividend was 58 cents every single month, but it's not. It varies considerably month to month. The bottom line is it's impossible to create an accurate yield number if you have a very short history and variable dividends. So I think the best that we can do is take the average of the 8 dividends that have been paid out so far, which comes to about 48 cents. Then multiply that monthly average by 12, which gives us $5.78. Divide that by the current price, and we get a yield of just over 13%. We can debate about the math, but one thing's clear looking at these numbers, and that is that JEPQ is producing a lot of income relative to its price. The basic features of JEPQ are very similar to JEPI, so we'll just blast through them really quickly. They're both actively managed by JP Morgan, they both have really long names, and they share a portfolio manager. JEPQ has 3 portfolio managers, but one of them, Hamilton Reiner, is also a manager for JEPI. Both funds are traded on the New York Stock Exchange ARCA, which is where most ETFs are traded, so you can buy and sell them just like a stock, which means you could use any stockbroker in the US, or if you're from outside the US, you could use Interactive Brokers. I'll put a link to them in the description. Fees are relatively low for an actively managed fund at 0.35%. The income is taxed as either ordinary income or capital gains, but so far it's been 100% ordinary income. And lastly, the source of that yield that we looked at a moment ago. There's a small amount of dividend income from the stocks in the portfolio, but most tech stocks pay very little, if any, dividends. So most of the yield comes from a covered call option strategy, which we'll get to shortly. Let's take a look at JEPQ's 3 objectives and whether it's actually achieving them. Objective number 1 is generate the majority of the returns of the benchmark. And in this case, the benchmark is the NASDAQ 100 index. There are over 3,000 stocks on the NASDAQ, and the NASDAQ 100 is the 100 largest of those stocks as measured by market cap. You probably guessed that part. There's one additional criteria, and that is that financial stocks are excluded. So, for example, Interactive Brokers, the stockbroker that I use, is listed on the NASDAQ, and it has a market cap of about $32 billion, which would qualify it to get on the NASDAQ 100, except it's excluded because it's a financial stock. Okay, let's look at total returns, which accounts for the price movement, which you'll see on most graphs like Yahoo Finance, but it also accounts for the dividends that are received. You can find a total returns graph on Seeking Alpha under the section Momentum. There are several graphs on there, but the one we want is titled Total Return versus S&P 500 Return, but you can customize it to compare it against other ticker symbols. There are some default time periods like 1 year, 5 year, but I wanted a custom time period to show the performance since JEPQ began, which wasn't long ago, May of 2022. And over that 267-day period, JEPQ didn't just provide the majority of returns associated with the benchmark, it actually beat the NASDAQ 100, represented on this graph by the ticker QQQ. That would be pretty impressive, except for two things. Firstly, it just so happens the market fell during that period, so it's not that JEPQ made more money than the benchmark, it just lost less. Now that's important and it's good, but we'd like to see what happens during a bull market. More importantly, the period, just 267 days, is too short for us to draw any real conclusions. I think what's more interesting is how JEPQ beat the benchmark. I showed you total returns, which includes dividends. If you simply enter JEPQ and QQQ on a price chart, JEPQ loses. In other words, it was the dividends that allowed JEPQ to win. And that's not necessarily good or bad, it just shows you how important dividends can be. Let's move along to objective number 2, and that is to provide less volatility than the benchmark. In other words, it shouldn't fall as far as the benchmark during a market crash. That's important. Well, I just showed you how JEPQ fell less than its benchmark NASDAQ 100 during a down market, so yes, it is less volatile. But if we get technical for a moment, JEPQ has a beta of 0.76. That means that if the NASDAQ 100 declines by 20%, JEPQ will only decline about 15.2%. So yes, objective number 2 is achieved. And objective number 3, provide incremental income, meaning more income than the benchmark. That's easy because the NASDAQ 100 only produces a yield of less than 1%. So yes, it's achieving its 3 objectives. JEPQ's portfolio is more concentrated than JEPI's, and that's an important distinction between the funds. JEPQ is choosing from a pool of 100 stocks, and JEPI is choosing from 500 stocks. As of January 2023, JEPQ held 86 stocks, whereas JEPI is spread across all the major sectors. You can see a nice pie chart on Seeking Alpha. JEPQ is concentrated. There's a lot of pink there. If you add up tech and communications, that's the majority of the JEPQ portfolio. If you read the prospectus for JEPQ, the fund managers also had the discretion to sprinkle in some stocks that are outside of the NASDAQ 100, and they could do that to reduce volatility. For example, you can see that as of September 2022, the portfolio included some stock from the hardware chain Lowe's, not a tech stock. The stock portfolio drives the price of JEPQ, but most of the income doesn't come from stock dividends. Just like JEPI, up to 20% of the fund can be used to create income using a covered call option strategy. And those covered call options are written on the S&P 500 for JEPI, and they're written on the NASDAQ 100 index for JEPQ, or more specifically, an ETF that replicates the NASDAQ 100 index. JEPI and JEPQ don't sell those covered call options directly. Instead, they outsource it to several banks in the form of equity-linked notes, or ELNs. And if you're not familiar with ELNs, I explained them in the JEPI video. The bull case for JEPQ is pretty simple, that it continues to outperform the benchmark because the strategy works. And when I say the strategy works, I mean that the asset managers are good at selecting and trading the stocks, which in this case are focused on tech, and also that the ELNs continue to produce consistent income. And it's important to note that covered call option strategies produce more income during volatile periods, which is what we've had basically since the pandemic. Now that's pretty similar to what I said about JEPI, but there's one factor to add if you're talking about a bull case for JEPQ, and that is that it assumes that the tech sector will continue to outperform the broader market over the long term. The downside risks for JEPQ include the same 4 risks that I mentioned for JEPI, and those were limited upside, ELN counterparty risk, variable dividends, and limited history. The JEPI video explains each of those. Beyond those 4, JEPQ is subject to one additional risk, and that's concentration risk. We already know that JEPQ focuses on tech, but more specifically, it focuses on big tech. Even though the JEPQ fund holds somewhere between, say, 70 and 90 stocks at any one moment in time, a third of the portfolio is in just 5 names. And those are Microsoft, Apple, Alphabet, aka Google, Amazon, and Meta Platforms, aka Facebook. And by contrast, the bottom 58 stocks in the fund represent 38% of the portfolio. So to a large extent, JEPQ is a bet on big tech. And credit to Stephen Fiorillo's article on Seeking Alpha for those percentages I just quoted. So that concentration explains why JEPQ has been trailing JEPI in performance recently. Basically, tech has been pulling it down. My take on JEPQ is that I get paid handsomely to wait for a tech recovery. It's benefiting from market volatility, and inevitably that will calm down. At that point, the yield will probably drop down into the high single digits, and I'm okay with that. I bought some JEPQ earlier this week. It's riskier than JEPI because it's younger and it's more narrowly focused, so I set my maximum allocation for JEPQ at just 3% versus 5% for JEPI. Over time, as we get more performance data on the fund, I might adjust those percentages. Well, that wraps it up for JEPQ. More armchair income coming soon.